Hello, good afternoon, Dr. Jerome and everyone. Welcome to our corporate finance presentation. My name is Nur Aslina, and together with me, James Raj as the group leader and my group members, Vigneswaran. We will present our financial analysis of Westports Holdings Berhad for the financial years 2024 to 2025. Our study is a financial statements review supported by ratio-based performance evaluations. Let's begin. Here is how we have structured our presentation today. We will move through three main parts. First, I will take you through the financial statements overview. Second, James will walk us through the financial ratio analysis. And thirdly, Vigneswaran will cover the interpretation and strategic recommendations. All of our figures are drawn from Westports' published annual reports. Let's start with the first section. Let's begin with part 1, the financial statements overview. Westport Holdings Berhad, which we will refer to simply as Westport, is a leading port operator and terminal management company based in Port Klang, Malaysia. It operates primarily at Westport, handling a very large volume of container cargo as well as conventional cargo services. Importantly, Westport is a key player in global maritime trade and serves as a vital transshipment hub in Asia. This slide summarizes Westport's overall financial position and performance. Starting with the balance sheet, total assets grew from 7.77 billion in 2024 to 8.89 billion in 2025. This reflecting continued infrastructure investment and capacity expansion. The total liability rose from 3.96 billion to 4.72 billion, mainly due to higher operational obligations and the expansion financing. The shareholders' equity strengthened from 3.8 billion to 4.168 billion, supported by improved retained earnings. On the performance side, the revenue increased strongly from 2.34 billion to 3.12 billion. The profit before tax rose from 1.138 billion to 1.29 billion, and net profit improved from 897 million to 998 million. So the company grew on every major line, though you will notice that the margin came under some pressure from higher costs. Next, let's look at the key share and structural indicators. Earnings per share increased from 26.33 cents to 29.3 cents, in line with higher profitability. The dividend per share rose from 19.75 cents to 21.85 cents, with the payout ratio held steady at roughly 75%, a consistent shareholder reward policy. The net asset per share has improved from 1.1195 to 1.2181, this showing stronger book value. So, overall, the financial statements show strong growth in revenue and equity, with profitability rising more moderately in a cost pressure expansion environment. Well, we believe this reflects a balanced expansion strategy funded by their internal earning and control leverage. That concludes the overview from me, and I will now hand over to James to take us through the ratio analysis. James, over to you. Thank you.
Thank you, Azlina, for explaining the financial statements and giving us a clear overview of Westport's financial performance. Hi everyone, I am James. I will now continue with part 2, which is the financial ratio analysis. Financial ratios are important because they help us understand a company's financial health. They show whether the company can meet its short-term obligations, manage its debts, generate profits, and provide good returns to its shareholders. In this section, we translate the raw figures you have just seen into ratios that reveal Westport's liquidity, gearing, and profitability more clearly. Before diving into the ratios, this slide sets out the key financial data we use in our calculations taken directly from Westport audited financial statement for the year 2024 and 2025. These base figures, current assets and liabilities, cash, total debt, QT, revenue, and profit fit into every ratio in the following slides. Let's start with liquidity. The current ratio. Current ratio measures whether a company has enough current assets to pay its short-term debt. Westport's current ratio declined from 1.45 times in 2024 to 1.23 times in 2025. However, Westports still has more than enough current assets to cover its current liabilities, but liquidity has weakened year on year. The quick ratio. This ratio tells us whether a company can pay its short-term debts using its most liquid assets. Quick ratio of Westports fell from 1.44 times to 1.22 times, still comfortably above 1. So the company can meet short-term obligations without relying on inventory. The cash ratio, however, dropped more noticeably from 1.02 times to 0.69 times, meaning Westports is holding a smaller immediate cash buffer than the year before. Continuing with liquidity and gearing, working capital remained positive but fell substantially from 341 million to 101 million, which points to tighter short-term liquidity. On gearing, the debt to equity ratio actually improved from 0.28 to 0.23 times as debt reduced relative to equity. However, total liabilities to equity ratio edged up from 1.04 to 1.13 times, reflecting the higher operational and expansion related obligations we noted earlier. These slides complete the gearing and coverage picture. The debt to assets ratio fell from 13.89% to 10.74%. So a smaller share of assets is financed by debt, which is a stronger position. The equity ratio slipped slightly from 49.08% to 46.88%, meaning nearly half of the company's assets are still equity financed. Net debt to equity improved sharply from 0.08 to just 0.03 times because the cash and short-term investment offset most of the debt. Finally, interest coverage decreased from 16.25 to 11.15 times, lower because of higher finance costs but a still very strong ability to cover interest expenses. Now to the profitability and growth ratio. Revenue growth was very strong at 33.31% in 2025, up from just 8.93% the year before, indicating higher business volume and tariff contribution. The net profit margin, however, declined from 38.31% to 31.95%. Westports remained highly profitable, but the margin compressed because revenue growth came alongside higher costs and lower operating leverage. To round off the ratio analysis, return on equity improved from 23.52 to 25%, showing strong and rising returns to shareholders. Earning per share growth was 11.09%, in line with higher net profit, though slightly slower than the prior year's 14.98%. The dividend payout ratio held steady at about 74.70%, confirming a stable dividend policy. And net profit grew by 11.17%. In short, Westport delivered solid growth while continuing to reward shareholders. Okay, let us move on to part 3, which is interpretation and strategic recommendations. Here we bring the numbers together, benchmark Westport against its competitors, and set out what the company should do next. Let's interpret the financial performance and benchmark it. On profitability, the net profit margin decreased from 38.31 to 31.95%, reflecting rising operating costs and reduced operating leverage despite revenue growth. Return on equity, though, improved to around 25%, showing efficient use of shareholders' funds. Westport also maintained a high payout ratio of roughly 75% in both years, giving investors a steady return. Benchmarking against peers, Westport posted in the year 2025 revenue of 3 billion and net profit of 998 million. Northport handled 3 million 20-foot equivalent unit, up from 3.6 million, while Johor Ports holds strong Malaysian Rating Corporation Berhad ratings handle 0.43 million TUS, which stands for 20-foot equivalent unit, in the first 5 months of 2025. Westport's more comprehensive reporting makes this comparison more reliable. Summarizing the overall performance on business growth, Westport demonstrated strong revenue and profit growth in 2025. This is supported by higher cargo volumes and operational efficiency improvements across its core port operations. On the margin side, profit margins declined due to higher operating and expansion costs. The key insight here is the cost control efficiency must be strengthened to sustain future profitability. Turning to liquidity and risk. On short-term liquidity, while the ratios softened during the year, Westport still maintains positive working capital and adequate coverage, supporting stability in the future financial periods. On financial risk, the company's low gearing levels indicate a conservative risk profile and a strong capital structure, giving it resilience against economic downturns and operational volatility. On competitive position, Westports maintains strong market leadership in Malaysian port operations, backed by high profitability and efficient infrastructure utilization. That said, increasing competition from Northport and Johor Port highlights the need for continuous operational improvement and capacity expansion. Strategically, Westport's strong transparency and reporting standards position it favorably, supporting investors' confidence and better benchmarking within the sector. Finally, our strategic recommendations. First, on business scale and market position, although all three are major Malaysian ports, Westports and Northport compete directly in Port Klang, while Johor Port mainly serve the southern region with a more diversified cargo mix. Second, on profitability, Westport's more comprehensive financial reporting makes profitability comparison more reliable. And third, on operational performance, the growth of Northport and Johor Port shows competition is intensifying. So Westport should keep improving its operational and manage its cash flow carefully to support future growth plans. That brings us to the end of our presentation. To conclude, Westport delivered a strong revenue and profit growth in 2025, maintained a healthy and conservative financial structure, and continue to reward shareholders while facing some margin pressure and rising competition. Thank you, Dr. Jeremy, for this opportunity, and everyone, thank you for listening and your attention.